Right, welcome everyone to this additional meeting and replacement meeting actually, a recorded session to replace the meeting that is supposed to take place today at 1:30 on the 26th of November, but I changed it into a recorded session. Okay, so I will share some screen, which was the screen that we left before we finished on the previous session last week. I hope you already understand the mindset and you already put your mind into do financial planning like this. Okay, but even though you still have no plan to do an action of financial planning like this, at least hopefully I already explained you that this is how you do financial planning. Okay, so even though it's only for vacation, for holiday, for buying a new car, the ideal situation is that you don't mix any fund, any any savings into another saving with different objective. Okay, but I would like to continue explaining on this on our upcoming meetings. But first, I would like to come back into discussion of this insurance and investment. Okay. Now, this whole session will be discussing why insurance is not an investment, but why do we actually need insurance in our life? Okay, because insurance is actually important. If you if we discuss it in the field of financial planning, insurance, it is an important aspect, but it should not be included into investment, right? Why? Because, well, first we have to go back into the definition of insurance. You can see here, it is the transfer of the risk of a loss from one party to another in exchange for payment. So here, for example, you are sick or part of your family is sick. Um, you already have an insurance. The one party is you and your family, and the other party, which is insurance company, already had the agreement that insurance company will compensate you if something bad happened to the health condition of your family, right? But usually you as the first party need to do like a regular payment into the insurance company. While investment is actually you put money into something with the expectation of a gain. So if you see on the third point there, how it works is that you put some money into buying assets that will have additional value, and in the end it can generate income and it can create more wealth. So we already discussed about net worth. So investment, the final expectation of an investment is of course to increase your net worth, okay, to gain some more money. While in insurance you actually lose some money, but you lose some money for some special purpose. Okay, now I will switch into another slide, which is actually already put inside the Google Drive. Okay, so here the title is Insurance and Risk. Why the title is like that is because I also teach insurance in the subject of risk management, but I do think that I also need to teach, to deliver materials about insurance, even though it's only short materials into the subject of financial planning. Okay, so if you are listening to this through audio file through podcast, please open the file insurance and risk on Google Drive. Okay, the Google Drive link that I already sent you in the WhatsApp group. Okay, sudah? You already opened it? Okay, nah, good. So I will skip some slides. This is the definition of insurance we already discussed before. And the basic characteristics of insurance is that there are some pooling of losses. So in insurance, we actually talk about losses, right? Because insurance value the loss that we experience actually. So for example, it's like this. You see the situation that there are two business owners own identical buildings. The value is at $50,000, but there is a 10% chance each building will be destroyed by a peril. Peril is like an accident in any year. So loss to either building is an independent event. Expected value and standard deviation of the loss for each owner is, the calculation is more or less like that. I hope you can see the writings a little bit covered with red colors. But if you see that the standard deviation is 15,000, oops, right here, 15,000. The expected loss if an accident happened is $5,000, but it can deviate. Standard deviation here means that the maximum loss is $15,000, right? But if the owners instead combine their loss exposures and each agrees to pay an equal share of any loss, their expected loss is still the same, $5,000, but since they combine losses, the standard deviation will be smaller, 10,000, around $10,000. Okay, so this is the main principle of insurance. So the analogy is from these two people owning different buildings, but they agreed to combine losses. So rather than having maximum losses of $15,000, that is much money, right? So it's better they combine losses, so each can only pay, will only pay around $10,000, right? So if you add some more people to the pool to this combination, the standard deviation continues to decline. This is the explanation why if you pay for a package of insurance, for example, you pay for your father, your mother, and your older brother, and then that's three people, right? For example, you pay that for, let's say, 3 million rupiahs per month for 3 person. But if you add yourself into that package, then you have to pay for 4 person, but the price for each person will become cheaper. For example, 800,000 rupiahs per month. That's cheaper. So why it's cheaper? It's not because there is a discount from the insurance company, but because the standard deviation is declined, because more prediction of losses are combined and the standard deviation or the maximum losses can decline. Okay. Uh, So these are some basic characteristics of insurance. The first one is that you pay for losses, but for serious losses, which means that the loss that cannot be predicted, of course. And the second one is risk transfer. So the previous example was actually about risk transfer. And the third one is indemnification, which is the insured is restored to his or her approximate financial position prior to the occurrence of the loss. So the insured here means that the people who paid for the insurance is already measured in terms of their financial position before the loss happened. Okay, so there is an agreement between you and insurance company. So either there will be something bad happen or nothing bad will happen. You already agree that both of the parties have advantage of having an insurance. We will explain more about that later, but I hope you can understand me here. Okay. Now, this is about the loss. You can read it by yourself later, right? Okay. And here are some risk, which is recommended to become insured. For example, risk of fire, risk of unemployment, and other stuffs. Okay, I will I will try to see um, some important points maybe here. Now, some people they tend to think that insurance and gambling are the same, but are they the same? You can see it here that insurance, the first definition is actually insurance is actually meant to answer an existing risk. Okay, so we already know the risk, and afterwards we agree to pay for the insurance. Well, gambling is actually only creating a new speculative risk. Okay, and then of course there is this positive definition of insurance that it will be something socially productive because both parties have a common interest in the prevention of a loss, while gambling is not socially productive because the winner's gain is actually the expense of the loser. So a winner's gain is actually a loser's loss. So it's like you are killing some other people to gain something that you win. Okay. That's one interesting point. Well, the last one I would like to show you before we finish, because the other you can read it by yourself. Okay, some social benefits of insurance. The first one is, of course, the indemnification of loss, or it's like the putting values to loss. Okay, so actually if you lose something, there is no value in it, but with insurance you can actually measure the value that you expect to lose. Okay, the second one is reduction of worry and fear. The third one is source of investment funds. Well, this is debatable because, as I explained it before, insurance you should not actually see it as an investment. But here, some people think that it's a source of investment funds. Well, we can always agree to disagree on this. Okay. The fourth one is loss prevention, and the third one is enhancement of credit. While there are also a side of benefits or advantage of insurance, there are also some social costs of insurance. The first one is cost of doing business. The second one is fraudulent claims. Third one is inflated claims. And there are some more technical discussion about insurance that probably we will save for later, okay? But first, please read it by yourself and ask me if you have some questions. I hope you can provide some questions when we meet again on the next meeting. Okay, but well, yeah, it's already the end of the slide. So thank you so much. I'm so sorry because this session is quite short, but if you want, we can discuss the main points that we discussed here while we meet again on the live online meeting. Okay, thank you so much, everyone. Stay healthy. Have a nice day.